Good morning. Thank you for coming on such a rainy, gloomy day. Part of the reason for the title there is, I'm not sure if many of you read The Economist, or have a chance to read The Economist, or whether you have a personal life, but I on occasions do read The Economist. And the good thing about The Economist, of course, or the useful thing from our perspective, is that it brings an international view. It comes from outside Australia. And if you have a chance, it's worthwhile trying to dig out. They did a review of Australia not too long ago in a bit of depth. And it's quite interesting to get an outsider's perspective of Australia, because I think it's very different to how we see Australia at the moment from within. And their perspective, whilst having a crack at political debates, they're having a bit of a go at that, and they also had a bit of a go at our dressing, which I thought was quite interesting. But fundamentally, they saw Australia really as really in a golden phase. A golden part of the world at the moment, a fantastic opportunistic part of the world, and also in terms of the state of history, at a fantastic point of time as well. And if you think about Australia, fundamentally the arguments they're putting in a lot of detail, they saw us in a way as the California of the late 70s. Huge opportunity, huge potential. And if you think about us within the Hunter, we're also within a bit of a sweet spot within Australia. We have access to the resources and the opportunities that are coming through there. But at the same time, we're not so exposed to it that potentially we're concerned about the pace of growth that we're getting there and or the downside when that phase eventually fades away. So why is it gloomy? Hence part of the headline. And I'll try and explain to you why I think we are feeling relatively gloomy, even though fundamentally we should probably have a more optimistic perspective about Australia and about the Hunter regional economy. Okay, as is my wont, I'll go straight into the conclusions and I'll try and justify them through the presentation. So why is it gloomy? When it comes down to it, regional economic growth remains pretty robust. We've slowed. We've definitely come off a sudden global financial crisis recovery and a strong recovery that we had there. But it's a managed slowdown that has purposely been introduced from the withdrawal of fiscal policy and the withdrawal of open monetary policy. So they've lifted interest rates to slow down the economy. There are many places in the world though where they would be dying for that opportunity. But when it comes down to it, the regional economy is still pretty strong. We have substantial momentum in resources and resource-related infrastructure. And I think we sometimes get bored of that because we talk about these quarters all the time in the press on a continual basis. But the reality is we're only part way through that phase and we've still got a long way to go. The higher interest rate context is definitely producing softer consumption. Not dire, it's not the end of the world, but it's definitely weaker there. And flat housing activity, and I think that's where the gloom comes from. That's a big part of our economy. There's a lot of small organisations out there, and also touches in our household as well. We don't feel so good about going out and spending money at the moment, because it's a coal face in that respect. That's where some of the gloom comes from. But it's a bit of a cloudy set of clouds that's really given me how relatively rosy things are out there. And looking forward, the resources expenditure is really just going to carry on underpinning the economy over the next few years for sure. The only waiver on that is potentially whether we have a global financial crisis too, but I'm not going to go there. I'm going to leave that for our second speaker to address. And for the other sectors, it's a question of the RBA's view on economic balance. We had talk recently of there is potential of consumption and housing dragging the whole economy down. It's a big part of our economy, and if you get it wrong, if we go into a housing market crash, for example, it will take the whole economy down. But I'm not suggesting that's going to happen right now, but it's a question of the RBA's view about balance in terms of whether they keep interest rates where they are, whether they increase them or decrease them, and that will shape, for those guys who are in the resources sector or riding on the coattails of that resources boom, that will shape our future over the next year or so. And it's pretty opaque for you, but again, I'll leave that to our second speaker to address. So, I'll quickly go through, first of all, the labour market, because we get some good solid data about where the regional economy is out there. Then we'll look at the different currents. Obviously, there are different things going on within the regional economy in terms of business investment, commodities, household consumption, and the evidence we have in housing investment. And then I'll tie that together and go into the outlook. So, the labour market. As you can see there, it's the recovery from the global financial crisis, and we were shooting away. We had fiscal stimulus there, we had monetary policy stimulus until they've dropped rates dramatically. and we, you know, the regional economy picked up very quickly. But we've gone into this major slowdown, so the labour market has definitely come off, as you can see there, and that's purposeful. It is effectively what the Reserve Bank wanted, the Treasury wanted. They were trying to take the heat out of the economy, and we saw it in the region. The unemployment rate is actually, the latest unemployment rate is 3.1%, and that would give you, you know, it's phenomenally tight, and that would give you a sense that, you know, the labour market is still very tight, which slides a bit of contrast to that chart. But the reason I put this chart up here is this is participation rate, which gives you a sense of the number of people who are employed and unemployed as a proportion of the total demographic that could be looking for work. And as you can see there in the global financial crisis, more and more people were coming out looking for work because they saw that potential of getting a job as being good. But then since then it's fallen away. Participation rate has fallen away from 65% to 61%. We call this the discouraged worker effect, basically. So basically they don't believe the position's there and so they fade away. So that's one of the bits of evidence to suggest that, you know, the unemployment rate of 3.1% is getting disconnected. We do have a softening off of the labour market in the regional economy. The other bit of data in the labour market that gives us an indication of that is also job ads. Job advertising has grown very strongly during the global financial crisis recovery. We've seen it waning away for a while now. It's definitely carried on that trend of softening. That suggests that the labour market it's not weak, but it's definitely softened off, and that's going to carry on for the next quarter or so. Of course, you know, we have a lot of different currents going within the regional economy, so to give a bit of insight into that, I've just picked 3 particular industries here. There are also a lot more industries that employ total employment within them over the long term. Being the industries I picked here are mining, manufacturing, retail, trade. Mining, surprise, you know, exceptional long-term growth. It's not a huge employer. It's a relatively capital-intensive industry, so it's sort of, you know, its employment rate belies its influence. But when it comes down to it, you know, we've grown from about 7,000 people working in this particular sector up to about 17,000. We've got about at least double and maybe more in terms of people working there. And that's no big surprise, of course, it's a reflection of the strength in that particular sector. Retail trade, on the other hand, that circles a bit of an exaggeration because we're taking it from a peak there. But when it comes down to it, it's an illustration of the softening in the retail side. It's not been so good there, and we know that. And that's reflected in the employment data. Manufacturing, on the other hand, is another curiosity, actually. I mean, manufacturing, we know nationally, is facing headwinds there. We're facing headwinds of currency, and also in terms of business investment, we know they're pretty flat and they're not very confident at the moment. But within the region, it looks like a lot of guys have managed to turn their particular business to from making corrugated fences for a weak housing sector to making grinding balls for a booming WA resources market. And whilst I don't think, you know, we can suggest that manufacturing growth is going to continue at that pace, because at some stage, you know, the high currency and the competition they get from now is really going to start challenging that growth. But at the same time, it's been a remarkable performance over the past couple of years. Of course, you know, these industries are not laid out evenly across the regional economy, so I thought it would be a good idea to give us a bit of insight about what's going on within the region. Now, just to explain this map to you briefly, just because it's a bit fuzzy. It's nice and clear on my laptop, but it's not so great when it goes through all the wires. Okay, we've got Barrington Tops up here, Port Stephens here, Wollamai here, Newcastle there, Lake Macquarie. And what this shows you is the unemployment rate on a statistical local area, so a smaller scale. And the darker the area, basically, the tighter the labour market. And surprise, surprise, you know, the darkness is, you know, multiple singleton, Dungog. It's where all the resources investment is going on. Phenomenally tight labour markets up there, around 1%. Basically, you've got full employment in those markets. As you get into the edge of the lower Hunter here, we have deeper labour markets, so it's not a big surprise that they're not quite as tight, but at the same time, they're still benefiting from this. But the other point, other than the fact that the strength of how this is flowing through in terms of the upper Hunter and spilling into the edge of the lower Hunter, is that really that everywhere is still benefiting. I mean, the worst statistical local area on that particular chart, these are the latest figures being the March quarter, is the Great Lakes area. But in reality, the unemployment rate there is 7.1%, which is quite, you know, that's not a bad rate in historical terms. That's phenomenally tight. It's just down from 9%. So these numbers bounce around a little bit, but the point being is that the upper Hunter is phenomenally strong at the moment from an employment point of view. But at the same time, the whole region is benefiting, and that's coming through in terms of the employment, as reflected here. So let's have a look at what's going on within the different components that help inform our view of where we're going. Commodities, I haven't put too many national charts in here because I'm also leaving that to to our next speaker, but this is one in terms of just giving you a sense of the cliff face of work, and also a sense that this is value of engineering construction work to be done. So this isn't work that has been done, and we're observing it fast. This is work to be done. You can see we're on the cliff face. There's still all this work to be had. And this is just engineering construction. There's actually, this is from the ABS's survey of engineering construction. There's actually a bigger one in the new capital expenditure, which is even greater. So, fundamentally, the huge amount of resource activity is going on. How does that influence us in the region? It has a couple of different influences on us. Indirectly, this, of course, is associated with a huge terms of trade benefit, which we've talked about in previous quarters. Basically, we're getting a lot more money for what we sell overseas, and the things we buy from overseas are a lot cheaper. And the trade-off of that is that we get much higher currency, and we also get higher interest rates because the activity is hotter in the economy. So basically, within the region, for us, that means that we've got cheaper goods in the shops for us to buy. It means that we get a stimulus in terms of your businesses, theoretically, the inputs that you require are sometimes cheaper. We also get, if you're fortunate enough to own mining shares, there's an income stimulant from the dividends for you there, which stimulates the economy. But it also means that we have higher interest rates and a higher currency, and we have to deal with that in direct context as well. More directly, though, we also get we're not immune to the direct capital expenditure, and we also see direct capital expenditure. We're part of this story. And we get the benefit of, one, selling goods into that booming resources sector in terms of, to keep the supply chain, but also in terms of the employment, the higher wages, and so on and so forth. It's a huge stimulation as well. So just to give you a sense, don't worry about the details of this table because it's in the publication, you'll see what we'll add. But fundamentally, the point is, when we go through our usual investment projects monitor, we're looking at, a Woolies here, around about there, and 20 million here, 10 million there, a community block here, $5 million there, and maybe we'll get something large occasionally coming through in terms of a new part of the power plants being expanded or something like that, maybe mine occasionally. Fundamentally, we're just getting huge. The numbers that come through with these resources are absolutely huge. The smallest one on that list is $100 million. When you're talking about the mines, we're talking about $3 million worth of capital expenditures that's yet to come. This is not the stuff that's got some of it started now on this list. Most of it is still yet to come. When we look at the rail line work that's done, it's about $1 billion worth of activity now that's going through, but it's still yet to come there. And you look at the wharf expansion, there's just under $5 billion worth of work that's still pending, it's still going to come through. So fundamentally, we're getting a huge direct expenditure benefit coming out of this. Again, the story is it's not evenly displaced across the region, so I thought I'd give you a bit more insight again in terms of where this is happening. Now, this particular map shows you where the coal mines currently are in terms of the open cut and underground mines. There's a legend on your publication, so you'll be able to look at it in detail later. And there's a little bit of a mistake on there and see if the miners can pick it. But you look at where the proposed activity is going to go on. It's here, these are the proposed mines. This, of course, includes things like Wallara 2, which has got a few regulatory issues, obviously, before it will go anywhere. But one of the conclusions out of this, obviously, is that things are moving further and further up the valley. And we'll talk about that a little more in a second. But when you look at where the transport stuff is, the $5 billion worth of activity that the port is going to go into Newcastle, of course. If you look at the rail line, the Minimbar to Maitland kind of third rail line stuff is going in here. The other maintenance works going to Rutherford, Breeza, places like this. So the story out of that is really, that's not putting aside the $1.8 billion worth of F3 extension that's going on at the moment. The story at the moment in terms of this capital expenditure is it is an upper Hunter story, but it's also a lower Hunter story at the moment. There's huge stimulation going on across the regional economy, and that will continue over the next few years whilst this rollout keeps on going through. Of course, as the capital works come to an end and we move into the operational phase, over time it will disappear from the lower Hunter. The transport issues will be resolved, and that expenditure will go, and we will end up moving. The economic focus of this activity will move further and further up the valley. And as you can see, these mines, the proposals aren't this side of Singleton. There's one or two this side of Singleton, but the majority of the other side of Muswellbrook, and progressively over time, we're going to be going further and further from Metro and Newcastle, and that's going to create challenges, obviously more and more challenges for the upland communities, both in terms of the employment market, in terms of the housing market and the social challenges that those guys are going to face. They're facing them right now, but they're not going to go away overnight. Okay, the interesting thing about the resources sector, of course, is that monetary policy is really tinkering at the edges barely makes any difference to it, because when it comes down to it, their demand is global, and therefore you can't slow demand by raising interest rates. And also, where they borrow their money for capital expenditure, it's pretty much on international markets, so you can't slow down by squeezing the banks and giving them less money in that respect. So basically, the central bank has very little influence over them in that way. A little bit through the currency, because if you lift interest rates, then our currency gets more expensive, but only relatively small. Not the same for construction, of course. Construction is one of those sectors where we're seeing the heightened monetary policy slowing us down, and this is a purposeful thing, of course. They want to slow other sectors of the economy down so that we can manage the resources growth. We had the stimulus come through, which is the blue here, a bit of latent stimulus. I think there's some works at Singleton Army Barracks. But what we're seeing here, we saw a bit of a recovery in private sector demand, as we were expecting, because they got crowded out a little bit through here. But fundamentally, it's still below long-term averages. And when we know, when we speak to guys on the construction side of things, it's very hard to get finance. It's very hard to get people to take out investment at the end, let alone tenants expanding and so on. There's a bit going on there off the back of the fact that the regional economy is strong, but it's being held down within that strength. One of the other illustrations of what's going on in the business investment side of it is this is commercial vehicle registrations, which is a reflection of sales activity and business investment in that respect across the broader economy. And as you can see here, we had substantial growth post-global financial crisis with the stimulus there, but it's faded away with the tighter monetary policy. And this follows pretty closely with the employment chart. As you see, the employment was strong, it faded away. We can see this in terms of business investment and equipment as well. The interesting part of that, of course, is that in terms of trade, the rationale of that is that it's a stimulus because it makes goods cheaper. So basically the cars and various other commercial vehicles should be getting cheaper and cheaper, either if they're imported, definitely cheaper, and if they're competing against the imports because they're domestic, they have to be cheaper just to compete. So generally there should be a stimulus there. But it's not enough at the moment to overtake the managed slowdown that the central bank are pursuing. And finally, within the region, in terms of business investment, this is our quarterly series of business expectations, where we survey the business community every quarter. And if those of you who get surveyed, thank you for taking part, we appreciate it. And as you can see, fundamentally from the blue line, in terms of 12 months expectations, we're still pretty confident that things are going to be good. In the shorter term, it's a bit weaker there. There's a bit of a discrepancy there, and I think when it comes down to it, when we were taking the survey, there were people throwing rocks in the Greek streets, and it was all looking a bit concerning, and it potentially is still a little bit concerning. And also the carbon tax obviously is a very big issue in that respect, and it's sort of, I think that's way down on that pessimism there. But when it comes down to it from a longer term point of view, the business community is still pretty optimistic about the fortunes of the country economy. Okay, so that's business. Turning to household consumption, the damaged guinea pig, of course, reflects that we're not spending anymore. For a long time they were breaking the piggy bank and spending that money. At the moment, what we're doing is trying to repair the piggy bank and put the money, stuff the money back in. I've put this chart up before, but I'll put it up again just because this is one of the few national ones I've put up. The household savings ratio, because it's very important, fundamentally. Instead of our house prices going up and it's borrowing against the equity and spending that money and stimulating the retail side of it that way, what we're doing is the reverse now, basically, because of the concerns, because of the awareness of consumers, basically we're saving, putting money aside, and we're not spending it in the shops. And this means that it's just almost a self-enforced thing from a household point of view, which is rather interesting rather than from a government obligation point of view. But when it comes down to it, it's definitely one of the things that's contribution to weakness in the retail sector. The other factors that we believe may be influencing the retail sector are things that utilities costs, other fundamental costs eating into disposable income that people can spend. And also the fact that people are going online buying overseas. And the other side is that people are going overseas on holiday, because we know a huge amount of people are going overseas at the moment. And basically you go to New York, go to Hawaii, spend all their resale money there, discretionary income, and then come back and don't spend it and go buy online cheaply where they can. And that's of course slowing down retail and consumption. And we can see that in terms of the regional data. This is again passenger vehicle registrations reflecting car sales fundamentally. And you can see, we basically haven't recovered. This is a global financial crisis, and we're slowly getting back, but we're still soft basically. and that's because we're putting the money aside, we're just not spending it. We look at, and that's despite, you know, in terms of trade benefit of cars getting cheaper and cheaper, it's just not enough to overcome that conservatism. When we look at our surveys of spending expectations, the red is the June quarter's figures, and it's better to compare it against the hatched one last year because there is a seasonality difference in terms of the preceding quarter. But fundamentally, you know, given confidence intervals, because this is a survey, it's hardly changing at all. Basically, we're static, we're staying the same as we were last year, which is a stable scenario, which means, you know, ongoing weakness on the retail side. It's not really dramatically soft. It's not desperate, but it's just not strong. It's just soft. The only exception, as we talked about in the last quarter, is holidays. Fundamentally, you know, that hasn't gone anywhere, but it's going nowhere from a strong position. It's above average, and people are saying, okay, so the currency is just too good at the moment. I'm going to go overseas. And finally, consumer confidence, our series here. As you can see, you know, we got very overexcited that it wasn't the end of the world for us at the end of the global financial crisis. We mellowed down to there, but we continued that caution. That wariness in terms of households has continued to increase, and this is where the gloom is. Even though, you know, rationally from the outside things look pretty rosy, this is where the gloom is because of the high interest rates. Households are just very wary, seeing bad things on the news, putting their money aside. And what that means is that's not positive for retail. There's a close association between consumer sentiment and spending, and it doesn't say, the implication is that it's not going to turn around in the shops overnight within the region. Okay, finally, turning to housing investment, as Wedge said, there's a whole residential market outlook out there, but I basically just don't have any time, unfortunately, to get into it in too much detail, what's going on in the housing market. But basically, we have the housing market, we got a little bit excited there with the upturn. Interest rates got stimulated with the global financial crisis. They cut them down, we got away a little bit there, but then since they've returned, house prices have gone nowhere, just stayed pretty flat. That's the demand bit. We've got just got fundamentally a stable, kind of boring housing market, which in the current global context and in the national context will take that. That's not a bad thing to do. The interesting part of that is the sales volumes and other things. That's pretty good. That's turning over. Houses are turning over. If you're a real estate agent, you know, your business should be okay. You should be taking your share of that in terms of turnover, and that's a reflection. You know, it's not a reflection of weakness in terms of overly cautiousness during a global financial crisis. And there are plenty of markets out there looking like this within the region. We've got a flat market, but it's turning over and it's reasonably robust. Just touching briefly on sentiment, because this is an indication of people's willingness to get out there and start kicking things off again in the housing market in the region. You look at the grey ones as total sentiment, and as you can see, pre-global financial crisis, you know, it was waning a little bit, fell away with the global financial crisis, and then they made the cuts and they got a bit of stimulus. Oh, sorry, actually, no, this is where they made the cuts, we got the stimulus. People got a little bit excited. But then as they've increased interest rates again, sentiment's fallen away. And it's, you know, they've stopped making cuts late 2000. And so, you know, people have got used to that, so down a bit, and their willingness to buy, go out there and buy, or in this respect, is whether people think it's a good time to buy low, to come back a little bit. But fundamentally, it fits with the benign kind of functional thing. It's just not going to change in the short term. People are not going to not spend, but at the same time, they're not rushing out there. There's no madness either. First-time buyers, which are a key part in terms of feeding into the bottom of the housing market with investors, they provide liquidity in the market and turnover and enable people to move into new construction and so on and so forth. You know, with the global financial crisis, the interest rates cut, they got excited, came back out to the market and stimulated a bit of construction activity and a bit of price growth. But since the interest rate rises have come through again, they've disappeared. Basically, they haven't come back again. And basically, I would say another illustration of the fact that the housing market isn't going to shoot away from us overnight, because we'll need some monetary policy stimulus in terms of interest rate cut before they'll really start kicking off again. So finally, just how is that flying into the construction sector? I've just given you one chart here in terms of same story again. The black line is median prices, the red columns are volume and sales numbers. You can see basically, you know, with flatlining there as well. Price additions sort of fell by 5% or something, but that's just a point-to-point kind of issue. Fundamentally, we've just got a stable kind of boring market on the vacant lot side. Prices that cost about $180,000 to $190,000 out there. But the interesting part is this turnover is sound. It's not weak. It's not this dire situation that we had through here. And the reality is that a lot of markets out there, a lot of residential land markets, be it Wollongong, be it southwest Sydney, northwest Sydney, be it Central Coast, are looking much more like this. Their prices jump around like this fundamentally because their sample base of turnover of stock is relatively low. Whereas we are turning over stuff in that stock, and fundamentally that comes down to the fact that we've got a strong employment market. People are confident in the future, and so we've got one of the few functional land markets in New South Wales at the moment, I believe. Now, that's actually flowing a little bit into approvals as well. Not dramatically, it's not flying away. The house approvals, detached house approvals in the region, for example, increased by about 4%, on a value basis by about 15%. And plenty of the other markets would be more than happy to have that kind of figure. So fundamentally, we're seeing a bit of activity here, but it's not really shooting away either. But it's a positive sign for those who work in the house and land package world. So, to wrap up again, why so gloomy? If you look at it from the outside, things are pretty strong. The reason you're feeling gloomy is because the housing it touches the retail side. You're not actually going out spending yourself, and people are putting money aside and all that kind of thing. But when it comes down to it, that's because of a strong story. It's because it's a managed slowdown, and the pressure is being put on those sides not to spend to manage this growth. There are plenty of places in the world that are dying for that situation. There are plenty, even within Australia, the Gold Coast and tourism-focused areas will be dying for that situation. Regional economic growth is pretty robust, but it's definitely slow policy intervention. That's the point. We've managed to slow down rather than there's no demand and how we generate it. We slow demand consciously, and therefore that means that we can undo it as well. That's at the national scale, of course, but within the region will reflect that. There's still substantial momentum for resources and resource-related infrastructure, and that will keep on underpinning our regional economy over the next few years for sure. But the higher interest rate context is definitely producing soft, not dire, but soft consumption and the flat housing market. And that's effectively what the central bank wanted to achieve, and we're seeing that within the region. But we're not in a desperate situation, but at the same time, that's why the guys in retail, that's why some of the guys in housing are just not, they're struggling. And that's why it feels gloomy, because it's the largest part of the economy and it touches base with us in our households. And looking forward, the things that are going to vary away from that, resource expenditure is going to carry on. The only thing is if we have a major event on the global horizon, that's the only thing that will really impact on that. The same with the global financial crisis did. I'll leave that next speaker to inform us on that one. For the other sectors, it really comes down to the RBS view, as you saw with Westpac recently. Their perspective was that the domestic sector's consumption and household were actually tanking, and they were going too far. And in a way, that relates to that's the whole point of this chart. Basically, you don't only have to have a small stone over on this side, but because it's a large part of the economy, if that gets out of whack, the whole thing gets out of balance very quickly. We have very strong growth over here on the resources side, but they're trying to balance this with weaker growth over here. If it gets too soft, the housing market tank fundamentally, for example, then it would take everything down. That's why I always believe that the interest rate cuts are coming through. I'm not sure everybody's convinced of that. But when it comes down to it, that balance in terms of where the Reserve Bank thinks that how they think the domestic consumption side of things and the housing side of things is balancing off against the resources investment we're getting, that will inform the interest rate position going forward, and that will inform the regional prospects in those sectors. Thank you.